It's dancing on this line. We call this the break and the feign back in. It's dancing on the line that is our triggering event, that green line over there, and it's pointing to 3,694, and we've got other targets in and around that level. A confluence that's basically 37 to 3730 stroke 50. So if you think about the key levels, once we'd run 3,000, the next one was 3.5. We ran it, and then we had quite a substantial pullback. What's the next level between 3.5 and 4? It's 3,750, isn't it? And there's your confluence of targets. Remember, derivatives play a role in this, and it's called pegging, the law of round numbers. So that's what's gold doing.
Gold steadied on Friday and was on track for a modest weekly loss as investors reassessed the Federal Reserve's rate cut outlook in light of resilient U.S. economic data. Bullion traded below $3,340 an ounce, set for a 0.5% decline on the week after better-than-expected jobless claims and retail sales figures. Unemployment benefit applications fell for a fifth straight week, hitting their lowest level since mid-April. FrancisHunt, technical trader and creator of the Hyper Volatility Funnel method, notes that gold has twice held support above $3,250 and is now coiling for another move. His technical model suggests that if gold breaks out from its current consolidation, it could surge toward the $3,700 to $3,750 range. This target zone is psychologically significant, as round numbers often act as magnets in financial markets. Silver, meanwhile, is regaining momentum after a brief pullback, approaching the $38 level again. The US dollar is losing ground as the market processes recent CPI data and turns attention to the upcoming PPI report. Hunt points out that silver has led the recent rally in precious metals, and gold now appears poised to follow. Federal Reserve Governor Christopher Waller reiterated his support for a rate cut at the end of July, citing growing economic risks and downplaying the inflationary impact of tariffs. Hunt believes that this environment, characterized by falling bond prices, weakening returns, and rising uncertainty, naturally drives capital toward hard assets. People aren't escaping to gold and silver because of conspiracy theories, he says. They're doing it because the charts and fundamentals line up. It's just common sense. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Everyone can have a fancy opinion and talk a great story and tell a narrative. The question is, what's the chart say? What are the price movements actually pointing to? So I've spoken about a quite a lengthy period now where we have not had a particularly big move. We defined a range. I want to share this chart. You're asking, what's going to happen? Is there a real substitution debt? So we've confirmed that debt is heading up. We showed the bleed out on the 30 and the 20-year on the US debt, and we showed a continuation pattern squeezing, starting to move out on the 10-year. My theory, you're going higher on rates. Forget all you think you're going to get. That's why there's this friction between Trump and Powell, because Powell is caught between the rock and a hard place. He'd maybe quite like to deliver cuts and not have this Punch and Judy show, which is all really a bit of kabuki theater, in my opinion. But in the long run, he'd probably not like to be so much in the limelight at the whole Trump narrative. But this is what gold. So we talked about the rates setting up a continuation pattern to go upside. Look at what gold is doing. There's your 3.5. Again, key rate. Remember, the 10-year was at 5%. Here's your continuation pattern for gold. That's what it's doing. That's what it's doing. It had such a strong, by the way, April of this year, remember I said to you, debt rates spiked, dollar collapsed. Here's what gold did. So it had a super surge. That's gold super surging to 3.5. Okay, after you've done such a fast move, you were sitting at about 2.9 here. We'd said you'd run the 3,000 and have a pullback. There was the pullback. And then you got tariff tantrum. That's what gold did. Bang. Okay, if you're going to move that much in such a short time, you're entitled to a continuation pattern and a breath. It went from jogging to sprinting. So there's some degree of, okay, we've held the 3,250 here twice. since the exhaustive move up and down, and now we're squeezing and we're going to go higher. Some might say, well, you're still in the range, Francis. I'm not sure that's going to happen. We have, again, HVF method, draw tool. We'll pop it on and we'll show you why we've been talking about a breakthrough to 3,700 and possibly 3,750 on a little bit of overperformance. There's the setup. It's dancing on this line. We call this the break and the feign back in. It's dancing on the line that is our triggering event, that green line over there, and it's pointing to 3,694, and we've got other targets in and around that level. A confluence that's basically 37 to 3730 stroke 50. So if you think about the key levels, once we'd run 3,000, the next one was 3.5. We ran it, and then we had quite a substantial pullback. What's the next level between 3.5 and 4? It's 3,750, isn't it? And there's your confluence of targets. Remember, derivatives play a role in this, and it's called pegging, the law of round numbers. So that's what's gold doing. And just a couple of metals that are correlated to gold right now, also in a similar structure, already with a draw on it. Here is platinum. The true white gold, even rarer, and look at that breakout. And that's it. It's happening right now. There's our stop loss placement. There's your triggering event. Right now, as we are talking, you and I, on that terrible rates, PPI inflation number, which probably points to a wrecked economy, this is going up. But I don't care if it had even come in hot. Target, you're talking in and around 1,500, 1,487. Now, I've got trades on in 900s with a 9, with 3 digits. And we're going to 1.5 soon next on platinum. It's the outperformer of the year right now. So, I mean, that is, yeah, I mean, you can see it right there. So, I mean, that's platinum. And then, of course, everybody recognizes that silver had an absolute bolter. I'll just take the volume out. And it broke out very, very similarly. Up, up, up. A little bit of hammering now, getting ready to go. So it's super surge. It was during this week, it was the outperformer of, that was last week and the week before. A little bit of a pullback after running because gold hadn't yet broken, but gold's getting ready. So that's what the rest of the metals are doing. And they're the less big ones to gold, but gold will follow now. But it's no longer almost the leader. Now the smaller guys are waking up and they're sprinting. Gold is the big old king. He gets up from his chair slowly and he strolls up the hill. These other guys are runners and they're getting their running shoes on. So if metals are all in technical setups to the upside and rates are all in technical setups to the upside, which means debt valuations are downward, about a breakout to the downside, I don't think it's a ridiculous conspiracy theory to say people are divesting from a devaluing asset paying a crap yield that doesn't meet inflation and getting into a preservational asset like gold and silver and platinum. So, I mean, I think that's not opinion, that's charts. And I always come back to that because I want to know what's the trade. Everything else is people's best guesswork. But that's the charts for physical stuff. So there's two worlds. There's a dichotomy. Them to you, go get digital. Biometric is awesome. Crypto is awesome. We're going to do this. We're going to do that. BlackRock behind the scenes, governments behind the scenes. Where do we get the XYZ resources? Scavenge mode for stuff and things in an environment where fiat and debt debasement, which goes hand in hand, as I keep pointing out, if you've had a major debt debasement in your bond market, you're going to get a commiserate currency buying power devaluation. So those guys are saying one thing and doing another. Larry Finkelstein, as I call him, is absolutely ecstatic about tokenization as a concept and you declaring and having an NFT that shows everything you own in the internet. I don't think that's a good thing for you. Whilst at the same time is getting into every single country. He's buying up properties, distressed properties all the way. Even in the UK, they're talking about BlackRock acquiring. When and where are the people that call for the breakup of BlackRock? It's time. They don't have a diverse enough board. I want to see it diversified out, and I want it broken up into small smithereens. These guys are they brag about escaping your national government. They see themselves as the transnational government over you. These are right to rule people. BlackRock is not hated enough. We need more headlines demanding the breakup of BlackRock. Hear me now. It's your enemy. It's your biggest enemy. They're directing everything. And when you give your assets to be managed, you buy Bitcoin in a BlackRock ETF, you are giving them proxy votes of power over you, and they have nefarious agendas that are actively working against your welfare. And people need to understand that. So a little bit of a reset comment thrown in there with great enthusiasm, but buy your own gold and custody your own gold.
As Donald Trump celebrated the congressional passage of his self-branded Big Beautiful Budget Bill, concerns over America's ballooning debt returned to the forefront. The new budget, centered on tax cuts and increased spending, is projected to add at least $3 trillion to the already staggering $37 trillion national debt. Critics have emerged across the spectrum, including Elon Musk, once an ally of Trump, who condemned the plan as a disgusting abomination. FrancisHunt, technical trader and macro analyst, warns that the repercussions are unfolding in real time. The U.S. debt burden is growing heavier, and now the dollar is losing ground while yields on 10- and 20-year Treasury bonds rise once again. According to Hunt, this signals a new phase of debt devaluation. Rising yields indicate that investors are demanding higher returns to hold U.S. debt, reflecting a decline in confidence in the government's fiscal trajectory. Though investors have been broadly bearish on the dollar throughout the year, strategists at Citigroup recently suggested that the greenback might be due for a short-term reprieve. Still, the broader trend remains intact. Capital is shifting away from paper promises toward tangible assets. Hunt emphasizes the importance of preparation over panic. It's not about pointing fingers, it's about facing reality, he says. Protect yourself, buy gold, preserve your capital. When the system breaks, and it is breaking, those who planned will be the ones still standing. In an environment of unsustainable debt, eroding trust, and fiscal overreach, gold remains a lifeline for those seeking stability amid systemic volatility. Let's get back to the interview.
We had the debt devaluation, which was the collapse of TLT, as we highlighted to you before. And that typically follows I call them the twin sisters. Money's borrowed into existence. You've got to think of them as two lead balls with a rubber band tied between them. And if I roll one down the staircase, the other one isn't going down at the same time, but there's a bit of traction, a delay, and then it slows down because it's being held by the other one, but then it pulls the other one down towards it. So you get this sort of staircasing down of these the currency market and the debt market, which again, this is your World Cup that I say everybody should be watching, because this is the foundation of the economic system. Everything is layered on top of it, right the way up to equities. It's capital formation and IPOs. This is all money banks. All of them have to exist. If you have a collapse of the debt market, you don't have any of these. You have counterparty failure, you have bank failure, you have all of this. Even our trading accounts will be cleared out, et cetera, et cetera. There's such risk if this goes badly wrong. And what's essentially happened is you had debt devaluation, and now you've had dollar devaluation. Now you're starting to see the rates going up on the 10 and the 20. So we're going into a second stage of debt devaluation. So you could get temporarily, relative to other currencies, many people thinking the dollar is oversold, you could get a rally here if you're measuring it against a euro, and it's already beating the yen at the moment, short term, and maybe even a pound. But those are all lepers in a leper colony that are slightly unsynchronized, but they've got the same disease. And they're all in different stages of it happening. The Trust Kwarteng had a super spike on their debt, but they're now higher than that on the long end, but it's not disorderly. So people have kept calm, but it's consistently getting worse. Trust me, Labour's long-term plans in the UK are going to assure a debt-based collapse, more so than the stimulus package that she put forward. And in actual fact, it was the Bank of England that didn't match the rates at which debt the US was hiking, that probably contributed a lot to the panic on the debt. I did a YouTube today, Tom, and just on that Trust Kwarteng thing, because I treat that as a microcosm of exactly what's going to happen to a lot of nations. And I said this, that it'll happen to America. And then we got the peak tariff tantrum when the US spiked in rates and the dollar crashed. And everybody's told you it's different for us. We're a hegemon, milkshake, everything. What actually happened is you had a chronic move in rates, and in actual fact, the dollar spilled. And what happened there? Gold went up and got bought. So hegemon, it's different for us. All of these copium narratives. If you're getting a loss of faith trade against you, you are not only getting your asset class sold off, you're getting the money removed from your boundaries, and that means it's leaving the dollar too. And the anti-dollar trade is gold, by the way. Even Americans staying with their money in the country, dumping dollars for gold, is an anti-dollar trade. So if you close out your pensions, you get it self-invested, you force them to sell all the bonds that they're holding, and then you receive a dollar amount and you go purchase gold. You just dunk the dollar and the bond market. In doing so. And you can be American. So a lot of people coming up with, it's the Japanese that did it to us, the Europeans, the Davos crowd, there's some peculiar, and I'm all for a conspiracy theory, but a whole bunch of peculiar conspiracy theories. I've got the stats. It was quite clearly Americans that had started to purchase, or money that originated in America. It could be offshore money that's been long-term settled in America, but it was Americans not buying American assets and starting to overweight in European assets, and it was capital leaving from within America to without. And a lot of that will be American billionaires, American hedge funds, a lot of that. So people want to nationalize things. This is a debt-based collapse with a hegemon, and this is how it goes down. And the other one has his head smashed like a tomato that's just been flung against the tarmac. That's how it goes. You're falling from higher. You've been an exporter of paper, and you let everyone else produce everything for you. This is how bad it goes when it unwinds. You're falling from a higher rung ladder. And it's difficult to get that. It sounds like I'm attacking people. There's a lot of emotional response to this. It's not a friendly narrative. I love the Americans. Buy gold. Preserve your capital. I would still say contemplate not seeing this downdraft and tax scavenge mode and everything that goes down with all of this by being in America. I understand that's a horrible message. I had to leave my homeland. It's not an easy decision, but knuckle up for a rough old ride. Yes, you can point out China's had a housing boom bust. You can point out Europe's a mess and all of that, but the hegemon falls from higher. It doesn't change that fact. The expectation is that the central bank has all the tools to continue to bail everybody out. And the overdraft is essentially they go to the primary dealers and they say there's trouble in the land of the global economy or the world economy and our nation economy. As a result, we need to dip into the overdraft. You're going to need to buy. And they normally do it when there's already some degree of fear in the market that sees money flying out of the stock market, out of all other forms of assets, and wanting a fear haven. And they capture that flow and offer to match it debt-based instruments, and that flow of money comes in and drives the flow of debt-based instruments. That means it's a favored, deemed to overperform assets class at a time of fear. Your problem is now that the whole world, the Western world particularly, is looking with a jaundiced eye on the debt category of asset class altogether. So whether you're Japan, whether you're the United Kingdom, or whether you're the United States, it's not an interesting asset class for people that do for-profit trading. Let's leave it there, in around 3.5 years. So how badly do people want to continue to catch that plummeting knife, being paid substandard yields and eating massive capital losses? Not really. So that's why central banks themselves have been buying gold. And actually the reserve asset of choice is something that'll still be there by capital. And it's the capital preservation over, return of capital over return on capital narrative. And this is what's happened. The debt market actually has only begun a process of unwinding 40 years of absolute ludicrousy and excess. Don't forget the 100-year Vienna bond that went out at 0 point whatever it did. That is peak lunacy.
confidence in the financial system is becoming a fragile illusion, tested by relentless borrowing and a weakening currency backbone. As key asset classes wobble under the weight of ballooning fiscal liabilities, capital appears to be flowing not out of fear, but out of necessity. Investors are no longer speculating, they're insulating. With gold consolidating near pivotal zones and silver regaining momentum, the market seems to be prepping for a directional shift not driven by sentiment, but by structural deterioration. A recalibration is underway, quiet yet forceful, as faith in fiscal stewardship erodes and hard assets regain strategic relevance. Could this subtle rotation into tangible wealth signal the early phase of a broader realignment, one where trust isn't measured in yields, but in what can't be printed? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.